nobody's been interested for so long. And with respect to gold, I calculated that, all over the world, if you look at, I think we got something like $300 trillion worth of portfolios. How much gold is in them? It's less than 0.5%. Partly because gold itself is not a regulated asset, and therefore your compliance officer jumps down in your neck if you try and buy any. But they're not yet really piling into ETFs, which of course the compliance officer has got no problem with. So I think there's an awful long way to go from that point of view before we even start talking about, well, what's driving gold? The answer is that the purchasing power of our currency is going down. They are not there yet. They don't understand it. They really don't. I tell you, I've got an uphill struggle getting people to understand that it's credit going down, not gold going up. Rise in the gold price means that cash flow pressures on mines are not as great as they were. So, I think that, the Citicorps and the UBSs from manufacturers are being given two fingers, basically, I think.
Yeah.
I think what you say is very interesting. There is another aspect to this which I want to explore a little bit with you. We had an announcement, I think it was the sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter, or compared with, previous quarter, the previous year, whatever. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together.
A recent ECB bulletin raised eyebrows. Gold derivative positions held by Eurozone institutions surged 58% over the prior period. This spike isn't mere speculation. It's tied to a crucial yet underreported factor: stands for delivery. Unlike typical futures trading, these positions require physical metal to change hands. Analysts believe delivery obligations accelerated after the Trump-era threat of 25% tariffs across all imports. As delivery requests soared, inventories struggled to keep up. What was once a niche concern now signals a broader imbalance in gold availability and possibly a brewing liquidity crisis in the paper gold market.
But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated. Now, nobody really notices this, but they are absolutely huge. Now, I know that the exchange for physical are even greater, but we don't know whether that's one way or the other way. I mean, it can be both ways. But we've got hard evidence with stands for delivery. Interestingly, the Bank of England's vaults lost 14,048,000 ounces between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million, for a total of 20,751,000 ounces.
Wow. Yeah, that's big.
The stands for delivery in that time, interestingly, were a bit over 22 million. 22,036,500. Now, you can't necessarily say that these figures are meant to match, but you can see that you got a problem on one side and you got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years. I mean, I think I'm right in saying that between 2021 and 24, stands for delivery were around about 2,100 tons.
Between October and April, the Bank of England's gold vaults lost over 14 million ounces, with an additional 7.7 million ounces drained from the London Bullion Market Association, LBMA. These figures closely match rising delivery requests on COMEX. While these numbers don't line up perfectly, they suggest physical gold is exiting key Western depositories at a pace that outstrips replenishment. This shift raises a serious question: who's demanding the metal, and why now? Many believe central banks, once content with leasing arrangements, are now recalling their gold, refusing to extend leases that supported decades of market stability.
This year so far, we're running at the rate of an annualized 1,500 tons. So we're running at close to 4 times the rate, if you like. More, I suppose. Now, the interesting thing, and this is something which I think the ECB is actually worried about, is that all this stuff disappearing from London, how's he going to get back? Because the point about an arbitrage is you do one leg and then you do another leg. And what you might do is you might protect your position by, say, taking out an out-of-the-money call option, just in case the price rises too much. But if you've actually, say, taken 20% premium, which at one stage you could do by literally begging, borrowing, or stealing bullion from one centre and selling it into another centre, you've got to get it back because you've got the obligations from where you got it. And this is the interesting thing, because the Bank of England, as I say, you had leaching out from. You had 14,048,000 ounces. Now, this is interesting because I don't believe that bullion banks and hedge funds, whatever, store much bullion in the Bank of England. It's predominantly central banks. Would you agree with that, or am I wrong?
No, okay. You're right.
So what that means is that the system whereby the Bank of England turns around to a leasing central bank and says, "Don't worry, you'll earn 1% or whatever the figure is, and it'll pay for your storage costs, which is lovely. It's lovely for us, lovely for you." And we have a book entry transfer system. So, the bullion stays here, and at the end of the lease, you'll be able to get it back. It's gone. It's gone. So what happens? I mean, put yourself in the position of a central bank. You say, well, I don't like this. Where's my gold?
The backbone of the modern gold market has long been built on paper contracts and trust-based lending, not physical ownership. But now that foundation looks increasingly unstable. With central banks less willing to lease and gold fleeing from vaults, the paper market's credibility is under threat. If gold isn't available when physical delivery is demanded, the system could unravel. Moreover, institutions active in bullion derivatives often also participate in other complex markets. A breakdown in gold could trigger wider contagion across the derivatives world. As liquidity tightens, the system grows more fragile, dangerously so.
The liquidity in the paper market is backed up by leasing and a rehypothecation of leases and all the rest of it. I would be very surprised if the central banking community are prepared to extend their leases anymore. I think they're saying, no, we're not doing this anymore. And some of them might indeed be saying, we want to store our own gold. Let's have it back. So this is fatal, really, for the paper market. And I suspect that the second half of this year, we're going to see this. Now, the problem you mentioned sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk escalating everywhere. And this is going to be actually well, let's put it this way, as the Chinese would say, interesting. One thing that's interesting in this is we see the gold price rising, up close to all-time highs and so on and so forth. The amount of interest in the West is actually pretty low. You look at COMEX and you see, as you said earlier on, you've got 440,000 contracts open. I mean, this to me is sort of marginally oversold. I mean, how do you get something marginally oversold at the top of the market?
Yes.
There is another thing. It was reported on Kitco, and I had some Australian friends who were asking me about this. The report that the average portfolio from the sort of people who've got a bit of money, and I think the definition when you delved into it were...
Despite high prices, Western investor interest in gold remains puzzlingly low. COMEX contracts are down to around 40,000, a marginally oversold figure even at market peaks. In contrast, gold enthusiasm in Asia is booming. An HSBC study reveals that affluent households in several Asian nations hold over 11% of their portfolios in gold or equivalents. In China, traditional investments look unattractive. Property is weak, interest rates are low, and equity markets are unappealing. With few alternatives, households are pouring savings into gold. Monthly accumulation plans, often government-backed, are driving a quiet yet massive eastward shift in global bullion ownership.
People who had over $100,000 up to $2 million, that sort of thing. I mean, sort of, if you like, the affluent middle classes. And they reckon that something, I think, between 11 and 12% of their portfolio was in gold or gold substitutes of one sort or another. Now, this is not our experience. So I dug into this a bit more. And in fact, it was an HSBC report which covered 12 different jurisdictions, only 4 of which were outside Asia. And the 4 basically were Australia, Canada, the US, and UK. Now, we know that our exposure, US exposure, portfolio exposure is, square root of nothing virtually. But what it does indicate is the level of interest in Asia in gold. And it's far higher than we think. This bull market, if you like, in Asian terms, has got a long way to go yet. Because, of course, if you look at China, the alternatives are not that attractive. I mean, the banks have reduced their interest rates, so deposit rates there are a waste of time. Property is a busted flush. Stock market is not everybody's flavour. Yet household savings amount to 35% of GDP. I mean, an extraordinary level of savings. This is going into gold. And we're talking about an annual flow of over $2 trillion.
In the West, gold remains vastly underrepresented in investment portfolios, making up less than 0.5% of total global assets, according to recent estimates. This is partly due to regulatory restrictions and compliance hurdles that discourage direct gold ownership. While ETFs provide an accessible route, widespread adoption hasn't yet occurred. Meanwhile, the purchasing power of fiat currencies continues to erode. Though many investors haven't grasped that gold isn't rising, currency is simply weakening. Until that realization hits mainstream financial consciousness, gold's bull run is far from over. The physical market is awakening, and the world is quietly shifting back to sound money.
So, this is an interesting juncture. And remember also that Chinese housewife, Mrs. Wong or whoever she is, can't rush out and buy dollars or Swiss francs or whatever verboten. So the only thing she can do is tell her bank, open a gold accumulation plan for me and feed X thousand yuan into it every month. And that's what's going on, I think. And also India too. That's interesting. And of course, both nations, and this takes us back to silver, both nations do see silver as money, even though we've forgotten that. And central banks don't get involved with it generally. I mean, PBOC is involved with it because they have the monopoly, if you like, of acquiring and disposing of the nation's silver. But other than that, no central bank is involved with it, or they certainly don't make returns showing that they hold silver as part of their reserves. But I can just see these shortages mounting. And as far as the West is concerned, the underexposure in portfolios is really quite shocking. I mean, you would normally expect in a balanced portfolio to see some mining stocks all similar, representing gold, silver, maybe platinum, or things like that, and maybe copper as well. But nobody's been interested for so long. And with respect to gold, I calculated that all over the world, if you look at, I think we got something like $300 trillion worth of portfolios. How much gold is in them? It's less than 0.5%. Partly because gold itself is not a regulated asset, and therefore your compliance officer jumps down in your neck if you try and buy any. But they're not yet really piling into ETFs, which of course the compliance officer has got no problem with. So I think there's an awful long way to go from that point of view before we even start talking about, well, what's driving gold? The answer is that the purchasing power of our currency is going down. They are not there yet. They don't understand it. They really don't. I tell you, I've got an uphill struggle getting people to understand that it's credit going down, not gold going up.